Hey guys, good morning. August 28th, Thursday. Best Buy just reported their Q2 earnings. Hopefully you guys had a chance to listen in on that earnings call. The stock this morning trading down 2.5% at $73.57 at the time of filming this video. I thought it might be useful to take just a couple minutes and go through some of the Best Buy results. And if you're invested in Gamestop, I think it is a useful comparison to look at what Best Buy is struggling with and what they are doing right, what is going well, and compare some of the metrics, some of the ratios from a fellow specialty retail competitor to GameStop, so that if you are one of those people struggling with the question that I hear said so often on social media, why won't they give value to GameStop with $9.5 billion of cash? There are answers in the financials to help answer that question and give you some inner peace. So without any further ado, let's dig into the Best Buy Q2 results and do a little compare and contrast to GameStop as we wait for GameStop's earnings on September 9th. Before we dive into the details, the headlines this morning after Best Buy's earnings call. The headline saying Best Buy reports modest sales recovery, but says tariffs are complicating its turnaround. Best Buy topped Wall Street's fiscal second quarter revenue and earnings expectations, yet the consumer electronics retailer stuck by its full year forecast, which it had cut in May. The company is contending with slower housing turnover, higher tariffs, and selective spending by shoppers. Looking at the summary sheet from Best Buy, a couple of key things to point out here. Revenue for the quarter, $9.43 billion. That is up 1.6% compared to the same quarter a year ago. On an annual basis, Best Buy brings in about $41.5 billion, and they've been on a bit of a decline since 2022. We can see that the bulk of that revenue is derived from the domestic segment and moving down into operating income. Their operating income as a percentage of revenue, 2.7%, a drop on a year-over-year basis. On an adjusted basis, though, it is very comparable to a year ago, 3.9% versus 4.1%. Diluted earnings per share, 87 cents, a significant drop from a year ago. Adjusted EPS, similar to a year ago, $1.28 versus $1.34. CEO Corey Berry notes that this comparable 1.6% year-over-year growth is the highest in 3 years and attributes the better than expected sales growth to a mix of new technology innovation, the company's focus on a seamless omni-channel customer experience, and strong vendor partnerships. And he goes on to say that they have a busy and exciting second half of the year ahead of them with tech innovation, new store experiences, and of course, the newly launched Best Buy Marketplace. And if you're not familiar with the Best Buy Marketplace, this was something announced very recently, a third-party digital platform that significantly expands Best Buy's products beyond electronics to include categories like automotive tech and licensed sports memorabilia. And the goal, obviously, with a third-party marketplace is to compete with the likes of Amazon and Walmart, boosting sales, increasing the product mix, while allowing customers to do returns in the Best Buy stores. It is very early. It obviously remains to be seen how successful this online marketplace will be for Best Buy. However, with the sluggish sales and the decline in overall revenues, this is a good attempt by the company to boost sales without having to load up their stores and their system with more inventory. Best Buy cut its sales outlook in May and said it expects full year revenue to range between $41.1 billion and $41.9 billion. That would be similar to Best Buy's annual revenue of $41.5 billion in the most recent fiscal year, but below the numbers it posted in the years leading up to and during the pandemic. Best Buy's domestic gross profit rate was 23.4% for the quarter. Compare that to GameStop, which in its most recent quarter had a gross margin of 34.5%. GameStop handily outperforming Best Buy in terms of gross margin. We'll get to operating margin and profit margins in just a minute. The next thing that I want to talk about, though, is the adjusted SG&A expenses over at Best Buy were 19.3% of revenue. And when you guys hear me talking to you about GameStop, I will continue to point out that The GameStop promoters like to focus on the whole number, just the number of SG&A, and GameStop's done a great job of driving down that number. But what I keep reminding you guys to do is exactly what Best Buy is doing here, what any sensible analyst would do. You look at SG&A as a percentage of revenue, 19.3% here for Best Buy for the quarter. Compare that to GameStop's SG&A as a percentage of net sales. They still have work to do. Even though they're driving the number down, they're still at, in the most recent quarter, 31%. This is where we get to dream a little bit, like what if GameStop does keep improving that SG&A as a percentage of net sales? That is money sitting there waiting to improve the bottom line of GameStop. And I am quite certain that management is continuing to focus on reduction of SG&A as a percentage of net sales. And if someone reporting on GameStop is not talking to you about SG&A as a percentage of net sales, that is a sign that they're dodging something that is important that normal people would look at, because it is news that they don't want you to have. I said that we would talk about margins, so let's do that real quick. A comparison between Best Buy and GameStop. You can see that GameStop has a higher gross margin, as we mentioned, than Best Buy, 30.55% versus 22.54%. However, operationally, GameStop is still challenged, only having an operating margin trailing 12 months of 1.58% versus the trailing 12 months operating margin at Best Buy of 4.14%. GameStop outperforming Best Buy in terms of profit margin and free cash flow margin, thanks to the interest that it is earning from that large amount of cash sitting on the balance sheet. But I would also submit to you that Wall Street cares about operating efficiency, and Best Buy is handily outperforming GameStop at the moment in terms of operating margin. So a little bit of work still to do at GameStop, and I know that management is actively working on this. In this analysis on your screen, I am using trailing 12-month margins. GameStop clearly in the most recent quarter is doing much better than what we see on trailing 12 months. And if that continues, that is good news, and it is reasonable to expect that will change some sentiment for GameStop. But we need more than 1 quarter of really good results. We need to see a trend over a 12-month period. And I hope that GameStop delivers that, a good data point here on September 9th. Looking at Best Buy's cash flow statement for the most recent quarter, operating cash flow is a positive $749 million, $175 million spent on CapEx, $65 million spent on repurchasing common stock. We like to see that. $201 million spent on issuance of dividends. Best Buy returning value to shareholders through dividends, and the company pays about 95 cents per share in a dividend every single quarter. Moving over to the balance sheet for Best Buy, that gives them $1.456 billion in cash on the balance sheet. Looking at current assets, current liabilities, total assets, and total liabilities, that gives them a total shareholders' equity of $2.7 billion and a positive working capital of $324 million. The balance sheet is in great shape. And you will notice that I am not talking about book value per share, because literally nobody cares about book value per share on any company, including GameStop, unless it is lower than the current market cap. This is another talking point that GameStop promoters and pumpers use to not talk about the things that actually matter, like return on assets, return on equity, return on invested capital, and fair value calculations of a company's stock. What Wall Street wants to know is, what is your revenue? What is the revenue trend? Is it going up? Is it going down? What are the earnings? What is the earnings trend? Are they going up? Are they going down? Is it flat? And are you returning value to shareholders through the payment of dividends? And then how are you utilizing any cash that you have on the balance sheet? ROA, ROE, ROIC. There is just not going to be value given to cash sitting on a balance sheet that is not being properly employed. You can give some speculative value to it. Wall Street is not going to value cash on the balance sheet with any sort of price target that you might want to see on GameStop until that cash is deployed. And then maybe we see things change for GameStop. It is exciting to think about the potential of what GameStop could do with its massive hoard of cash. And I am 100% certain that management is looking for a good use of that cash. However, Wall Street also cares about things that are basics of finance, things that any freshman in college would be taught in a finance class. These metrics that I have on the screen, which no one covering GameStop wants to talk about. How GameStop is underperforming its competitors on ROA, ROIC, and ROE, and how it is being negatively impacted by that cash on GameStop's balance sheet sitting unused. ROA is significantly impacted by idle cash not being employed to generate new streams of revenue. ROIC is also negatively impacted by cash sitting idle because the very definition of the formula is return on invested capital. Cash sitting unused is not invested capital, and so you're going to have a pathetically low ROIC until that cash is put to use. This does not mean that GameStop sucks, but if you're wondering why the price is not doing what you want it to, you must understand how the finance bros are looking at things that actually matter. And what actually matters is usually not what anybody on GameStop YouTube channels is talking about. They talk about things that is convenient to them, and they ignore things that actually matter because the numbers compared to competitors just don't look good, and they don't want you to have these facts. Here on my channel, as we cover stocks like GameStop and Best Buy, I want you to understand how Wall Street is looking at the play. You can have a different way of looking at it. That is totally fine. But you can't say that you don't understand the valuation of GameStop while you're ignoring things that actually matter, because like it or not, these things matter. I'm excited about GameStop's potential to put that cash to use, and I will be long on a speculative bet that they do announce something at some point, a good use of that cash, and people get excited and the price goes up. I can't promise you that's going to happen, but that is the speculative bet that I have. As we wrap up this video talking about Best Buy's Q2, let's contemplate for a second their forward PE ratio based on communication from management about expected earnings over the next 12 months. The forward PE ratio is 11.13. That is pretty low, and what I would say is fair valued. And when we compare that to something like a GameStop, a forward PE ratio of 36, you can see how some people might consider, when you're comparing direct competitors in the specialty retail sector, some people might still consider GameStop overvalued. And it is overvalued when you're looking at its performance that we know of to date. Maybe we get some exciting new updates on September 9th. What we are seeing here with the forward PE ratio with GameStop is a speculation that things are going to get better, or some news is going to come out that that cash was properly deployed and earnings is going to go up, and we can recalculate the valuation of GameStop. I certainly hope that is the case. And I know that management is not ignoring this overvaluation, even though people on YouTube appear to be. Management is selling shares, selling bonds when the price is overvalued, and they are not buying shares back. They understand fair value. They understand now is not the time to buy shares back. Maybe if it was trading back around $10 again, I would say, hey, Ryan Cohen, buy some shares back. But we're not there. We're at 22 bucks. We got some positive speculation going on here, and I am going to cross my fingers and hope that on September 9th, when we get the news, that it is news that everybody wants to hear. Leave me your comments and questions down below. Thank you for watching. I am Tony Denaro, and I will see you on the next video.